Welcome to another session on the capital investment and financing decision. In the last class, we talked about the cost of capital, and in this class, we'll be discussing more about the capital structure decisions that are faced by the enterprise and the manager. Now, as you might remember, we have talked about three different kinds of decision making: the um, investment decision, the financing decision, and the dividend decision. Now, this is about your this particular module deals with your financing decision, basically the capital structure decisions. Now, before we go to the decision making areas, we have to be very clear regarding the use of this particular term called capital structure. And very closely related with this term is another term which is called the financial structure. So, what is the capital structure and what is the financial structure? How are they different? Now, capital structure basically refers to the makeup of firm's capitalization. Now, what is capitalization? Capitalization is a mix of different sources of long-term funds. Now, we have discussed the other day that the various sources of long-term funds could be the equity, could be the debenture, could be the preference, or the term loans. Now, the mix of these long-term sources is known as the capital structure. That means if the firm's total finance, I mean the long-term source of finance is 100 rupee, what percentage of that is equity, is from equity or ownership capital, and what percentage of that is from the loan capital. That mix, 80-20 or the 50-50, whatever is the ratio, that ratio is known as the capital structure. Now, then what is financial structure? Financial structure refers to all the financial resources that are marshaled by a firm, because all that the firm can lay access to. Now, it includes long-term as well as short-term finance source of finances. So, the entire finance, be it long-term or short-term, is known as the financial structure. And in the long-term source, what is the mix between debt and equity capital? That is known as the capital structure. Now, with this understanding of capital structure, we now move to the various characteristics of these long-term sources. Now, here I have, as we discussed just now, I have talked about four sources of long-term finance: debt, debenture or bond; the preference capital, which is basically the hybrid between the debt and the equity, and you have the equity, and very closely related to the equity is the retained earning. Now, as we know, debt is a loan capital, equity is a ownership capital, and retained earning is the part of the profit which has not been distributed. So it also is called as internal equity. And then you have the preference capital, which is the hybrid between the debt and the equity. Now, what are the characteristics differences? Now, debt, the firm must pay back the money because it's a loan capital. The firm should pay back the money with whatever interest applicable. Whereas in case of equity, the money is raised by selling ownership. So there is no concept of repayment of equity capital. So the capital is perpetual by nature. And the preference could be redeemable if it is redeemable or irredeemable. If it is redeemable, it behaves like an equity share, and if it is redeemable, it will just like a debenture, and if it is irredeemable, it behaves like a equity share. Now, what is retained earning? The amount of money that is distributed as dividend. I mean, this is distributed to investors, known as dividend. The part of the profit that is distributed to the investors is known as the dividend, and the part which is not distributed is known as the retained earning. So the undistributed part of the profit with the company is known as the retained earning. Now, the interest rate for the debenture is based on the risk of the principal and the interest payment as perceived by the lenders. So, if the lenders perceive that your company has high risk, they will raise the interest rate. Whereas, and the payment of interest is contractual obligation, that is, you're legally bound to pay interest. Whereas, there is no such contractual payment in case of equity share. Now, the what should be the value of my share determined by the investor. Like, if they like my share, every investor wants my share, so that the value will go up. If every investor evaluates my share as not so much of value, so the price will fall. And there is not any the concept of any contractual payment to the shareholders. Now, however, for preference, the dividends are not legally required to be paid, but dividend on equity share cannot be paid unless the preference shareholders are paid the dividend. So, which means the moment if you want to pay the equity dividend, the payment of preference dividend becomes necessary. So the non-payment of dividend to preference shares for a very long time gives them the voting right. So in essence, they get converted into the equity share. Now the shareholder, whereas in case of retained earnings, shareholders forego dividend income, but they do not lose the ownership. So if new equity shares are issued, so they will get the right in that also. So this is the characteristic of your retained earning. Now, amount of money, the maturity, there is no maturity in case of your equity share, whereas the money is to be repaid after a certain specified number of years in case of debenture. Now, in case of internal retained earning, the funds are internal, so there is no involvement of any external parties here. Now, if you don't repay the money, lenders can take action against you as per the law. Whereas in case of equity, the voting rights will create changes in the ownership if you don't pay the dividend, or if the distance are not as such that the farm value increases. So, in case of debenture, the interest payments are deductible for tax, whereas for payment of equity and the preference dividend, it is not deductible for tax purposes, as we discussed in the last class also. So these are the basic characteristics of our long-term sources. Moving on, when I'm talking about determining the best capital structure or the optimum capital structure for my farm, there are certain criteria, guiding principles for this capital structure determination. Now, the principles of determination are these five. Now, the cost principle, it says that we should be availing the finance of the long-term source of finance in such a way that the cost is to be minimal. Debt is cheaper, as we all know. The equity is higher cost, so it doesn't mean that we'll go for the cheaper debt 100%, because that is not possible. We have to strike a balance between the cheaper source of finance and the long-term source of finance, or the equity capital, ownership capital, and the loan capital, so that the cost is minimal. And to discuss about this cost principle, we have many theories which we'll be discussing at the end of today's session. Risk principle, it should be such that the farm is not exposed to undue risk from the creditors. The control principle, if we go for, if we are going for raising of debenture, finance through debenture, now the risk will be high on the company. Whereas if we go for too much of equity, the control will be diluted for the company. Now, so we have to strike a balance between whether to go for debt and raise the risk, and go for equity and dilute the control. So we have to strike a balance. So risk principle, optimal risk and optimal control. Now the capital structure should be such that we have some amount of flexibility, so that I can change the, if I have a targeted capital structure, I have the flexibility of changing the capital structure to my own liking and to my requirement. And the timing, whenever whenever it is appropriate to raise debt, I'll raise debt. Whenever it is appropriate to raise the finance through equity, I'll do that. So that the timing, that is when it depends on the market sentiments. Now, what is the risk involved in case of the capital structure? We're just discussing the risk principle. So what is the risk involved in the determination of the capital structure? Now, when we talk about the capital structure, there are two kinds of risk faced by the firm: the business risk as well as the finance risk. Now, we'll pick up and discuss each one of them separately. Now, what is a business risk? Now, the business risk arises due to the relationship between the earnings before interest and taxes and the sales revenue. Now, why there is a relationship between these two, and what is the relationship, and that gives rise to this risk? Now, that we use a term called operating leverage. Now, this leverage is nothing but the presence of fixed cost. Now, see, if you might have seen that in case of while we talk about the sales revenue and all, remember you start your income statement from sales revenue. Then you deduct the various variable cost. So I'm talking about the basic cost sheet. So you reach at something called a contribution, and then you deduct the fixed cost. So you reach at the EBIT, earnings before interest and taxes. Now, this employment of this fixed cost is known as the employment of leverage. Now, if there is no fixed cost, what will happen is, if you don't have any fixed cost, for example, here I am give you a very, very small example. Let us say your sales revenue at 1,000 rupee, out of which your variable cost is, let us say, 300 rupee. Let us say that you are selling 100 rupee, 100 units at a price of 10 rupees. So your sales revenue is 1,000 rupees. So your unit price is 10, and your variable cost per unit is 3. So it is you are selling 100 units, so 100 into 3, that is 300. Now you don't, so your contribution is 700, and your fixed costs are nil in the first case. So what is your earnings before interest and taxes? That is 700. So your total cost is with the variable cost. Now, suppose my sales revenue now increases to 2,000. So my variable cost will go up to 600. So my contribution will be 1,400, and there will be no fixed cost. So my EBIT will be 1,400. Now see what happens. Here the rate of increase from this to this, there is a 100% increase in case of, there is a 100% increase in sales revenue. Corresponding to the 100% increase in the sales revenue, my EBIT has also gone up by 100%. So whatever I achieved in the sales revenue, the same margin I am achieving at the bottom line, the EBIT level also. Now suppose I introduce the fixed cost, that is, let us say here I introduce a fixed cost of around, let us say 400 rupees. If there is a fixed cost of 400 here, what will happen to my EBIT here? EBIT will be 300. Again, because it's a fixed cost, it doesn't change. So here also it will be 400. So here my revenue will, my EBIT will be 1,000. Now see, here I have a 100% increase in sales revenue. What is happening here? From here to here, my increase is about, let us say, 300%. Now see, and why is it happening? It is happening because I have now further sales revenue increases. This will increase subsequently. So this goes to 5,000. Now you can calculate how will the profit, the gross profit, how will it increase. So this is the employment of fixed cost is called as the employment of operating leverage. Now the greater the firm's operating leverage, that is the use of fixed operating cost, higher will be your business risk. So given that, so when I'm talking about a company A which has fixed cost and a company B which has no fixed cost, then a company A which has fixed cost is having a greater business risk. Now, in addition to this employment of fixed cost, you have revenue stability, you have cost stability. Now, both of these also affect the business risk of the firm. Now, revenue stability means how stable are your revenue? That means if you're talking about the increase, are they increasing 10% or 15% every year, or are they fluctuating? So the revenue stability, which means the variability of your firm's sales revenue, that also depends on the demand and the prices of your firm's product. Whereas cost stability refers to the relative predictability in your input prices. Now, what are the cost? Cost is raw material price, and the cost of operation. So that is your cost. So if your input prices are constant and the other costs like salary and wages and all those things, they are constant, then you will have cost stability. Now, the more predictable these prices are, the less is that means if the cost is stable and your sales revenue is stable, then your business risk is also quite low. Now, business risk varies from one firm to the other firm. Now, for example, if you cannot say that one farm A and farm B, one is in software, the other is in automobile, both of them have equal amount of fixed cost. If suppose hypothetically speaking, both of them have equal amount of fixed cost, doesn't mean that both of them have similar kind of business risk. The business risk varies from one farm to the other depending on the nature of their business. And business risk is not just affected by capital structure. In fact, capital structure decisions are influenced by the business risk. Now, suppose you have automobile is something that is exposed to huge business risk. Now, the point is, if you already are having dealing with business risk, then what kind of a capital structure should you have? It is not the other way around that my capital structure will give rise to business risk, but the approach is if you have already business risk with your enterprise, how are you going to decide on your capital structure? Now, for example, here I have given you a very small example of how to deal with this business risk. Now, see, and let us see how the business risk is computed. Now, for example, I have this is the example I've taken from the study material only. The Raz Cosmetics it is engaged in the process of planning its capital structure, has obtained estimates of sales and associated levels of EBIT. Now, the sales forecasting group has given an input that they have given three probabilities. Now, there is a probability that the sales will be 4 lakh, which is a 25% probability, and there is a 50% probability that the sales will be 6 lakhs, and there is another 25% probability that the sales will be 8 lakh. So now the highest probability is that the sales will be 6 lakh. This is what I have written here, that the 25% probability, the 50% probability, and the 25%, the total is 100% probability. Now here the sales will be, I have written in terms of thousands, so 3 zeros I have omitted. So 400, 600 and 800. Now the variable operating cost, like just we discussed, instead of per unit price, here it is given as a percentage of sales. The variable cost are 200, 50% of sales revenue, 50% of sales revenue, here also 50% of sales revenue. So if you, and the deduct and the fixed cost are again constant throughout the sales revenue, each one of them is 200. Now see, from sales of 400, I'm deducting the fixed plus variable, again 400. So first year I don't have any profit. Sorry, not first year. If the sales are 400, there is no profit. If the sales becomes 6 lakh, my profit is 1 lakh. And if the sales are 8 lakh, my profit is 2 lakh. Now, this variability of my gross profit. Now, see how the profits are changing. So, again, there is a 25% chance that the profit will be nil. There is a 50% chance that my profit will be 1 lakh. And there is a 25% chance that my profit will be 2 lakh. So, there is a great variability we are observing in case of the profit, gross profit or operating profit, whatever you might call it. So, this variability in the profit is known as the business risk. Now, let's talk about, having understood what is business risk, let's talk about a little bit about what is the finance risk. Now, the firm's financial, the capital structure affects the financial risk arising out of the financial leverage. Again, what is leverage? And this is reflected in the relationship between the EBIT and EPS. Now, just now we saw that the business risk arises due to the operating leverage plus other things revenue stability of revenue, and the stability of your cost, So these two also contribute to your business risk. Now, business risk arises out of operating leverage, whereas financial risk arises due to the financial leverage. Now, operating leverage, business risk talks about relationship between your sales revenue and EBIT. Whereas financial leverage or financial risk talks about the relationship between EBIT and EPS. Okay. Now, please keep it in mind that while we are talking about operating leverage, the EBIT is a dependent variable, which is dependent on sales revenue. So, sales revenue is independent and EBIT is dependent. But whereas when we are talking about financial risk or financial leverage, the EBIT is the independent variable and EPS is the earning per share is the dependent variable. So EPS depends on EBIT here. So EBIT in one case becomes dependent, in other case it becomes independent. So that is why in the leverage analysis of the capital structure decision, EBIT plays a very, very major role here. Our subsequent discussions will all be centered around this EBIT. Now, what is a fixed cost? If you remember, we started with the sales revenue in the first case, then we talked about the variable cost, then we talked about the fixed cost. So we reached at the EBIT. Then from here we deduct the interest. So we reach at profit before tax. From here we deduct the taxes and we reach at net profit or profit after tax. From here, if we deduct the preference dividend, we reach at, let us say, net profit. So this is how our figure goes. Now the point is, the introduction, if you have interest and if you have preference dividend, then you have financial leverage. If these two are not there and the farm is, see, if the farm has debenture, it will have interest, debenture or loan, it will have interest. If the farm has preference dividend, it will have preference dividend. Now, if the farm has only equity as a source of finance, then there will be no interest and there will be no preference dividend. So the farm will not have any financial leverage and it will not have any financial risk. Now, the suppliers of fund will raise the cost of funds if the financial risk increases. Now, see, the point is, it is when we have more and more of interest, because it is fixed by nature. Let us say if the farm has a 5 lakh loan at the rate of 10%, so which means every year the farm is supposed to pay 50,000 rupees as interest. Now, if your revenues are not, your EBIT or this earnings report, interest and taxes are not sufficient to cover the interest, then you will have problems. So whether you are having loss or not, that is not the lookout of the creditor. So you have to pay the 50,000 rupees in any case. So this is fixed by nature. And preference dividend, though the dividend payment is discretionary, but the moment you have to pay equity dividend, you have to pay clear all your preference dividend. Now the whole issue is that and if you non-payment of preference dividend for prolonged duration dilutes your ownership because they get converted into equity share. So the if you have interest and preference dividend, then you are taking up, and more interest and preference dividend is there, more and more is a financial risk. So the next time you approach the party for loan, they will not give you, suppose you have a lot of loan and preference dividend now, next time you ask for a loan, they will not give you at a 10% rate. Might be they will revise their interest rate to 12% or more. So the suppliers of fund will also raise their cost if you have financial leverage. Now we'll talk again about the same example. We are going to continue that we have discussed in the case of operating leverage. Now this company is now considering 7 alternative capital structures, means 7 different financing plans. Now which are what are those financing plans? That these are that you have no debt, 0 debt, you have 10% debt, you have 20% debt, you have 30% debt, 40% debt, 50% debt, and 60% debt. Now we are making some simplifying assumptions here. The assumption are that the firm is currently an all equity firm and there are no liabilities. And because we are talking about all equity, it must have some number of equity shares. Now it has 25,000 equity outstanding, and the par value of each of the equity shares is 20. So how much of equity capital I have? I have 25,000 shares into 20 shares. So that brings it to the 5 lakh rupees. Now 5 lakh rupee is the total capital of the firm, and currently it is all financed through equity. Now the total amount of capital, we are now keeping the total amount of capital constant. So when we are talking about 0% debt, so 5 lakh from equity, 0 from debt. Now when I am talking about, let us say 50-50, that means 50 from equity, 50 from debt, it is not that I am raising additional capital. At least I am assuming that 5 lakh capital is constant. So which is 2.5 lakh from equity and 2.5 lakh from debenture. That is what I am assuming. This is in real life it doesn't work like that, but for your understanding we are making the simplifying assumptions for working out the details of the financing plan. So what happens is here you see I have mentioned the debt ratios, and from 0 to we discussed about 60. I mean 7 plans, but here I'm showing you 4. You can calculate for yourself the remaining 3. So 0, 10, 20, 30. So 40, 50 and 60 I'm not showing you here. Now see, the total asset, as I told you, the total asset is going to be 5 lakh only. So I've written only in thousands. So 500 only each case. Now the first case there is no debt. The second case there is 10% debt. That is 10% of your 500. That is 50. The third case 20% of 500. That is 100. And the third case 30% of 500. That is 150. The total debt. That means you add up 3 zeros, 50,000, 1 lakh, and 1.5 lakh here. Now, the equity is obviously the remaining part. In the first case, the equity is 500. The second case, the equity is 500 minus 50, that's 450. Here it is 500 minus 100, 400, and 350. Now, what should be if that is the case, my equity share, how many equity shares will be issued here? Now, again, because this is the equity capital divided by then 20 rupee, which is the price of the equity share. I divide by 20, so I get the number of shares. So here 500 divided by 20, it gives me 25. 25 means 25,000 shares I have. In the second plan, I'll have 22,500 plans, equity shares. Third case 20,000, and fourth case I'll have 17,500 equity shares. Now my point is okay, so this is the financing plan that I have. Now we talk about the financial risk. Now see, before we go to the financial risk, as I told you, we're not talking about here preference share. We're only talking about 2 sources of finance, the equity and the debt. Now, before I actually talk about the risks involved here, let us talk about what is the interest I'm going to pay if these are the 7 financial plans I'm talking about. Now see, here I've shown you the 7 financial plans. Now starting from 0 to 60, left hand column, I'm showing you the starting from 0 to 60. So if you have, and these are the interest rates applicable on the different financial plans. Now see, is first case when you have 10% debt, the interest rate is 9%. But as you go on increasing the debt capital, the interest rates charged by the creditors is also increasing because they're perceiving more and more amount of risk with you. So in the first case, no debt, so there is no question of interest rate, so no interest. Second case, your debt amount is 50,000 and the creditors are charging an interest rate of 9%. So what is the interest that you have to pay? Cash interest, 9% of 50,000. That works out to 4,500, I guess. Yes. 50,000, 9%. Yes, this is not in thousands. This should be yes, 4,500 is the interest amount. In case of the second issue, my interest is this 9,500, then 15,000, 22,000, 33,750, 49,500. So this is how my interest will grow if depending on the 7 financial plans. Now we talk about it is not easy to pick up all the financial plans and show them using the probability. So I have picked up only 3 cases, specific cases: the 0% debt ratio, the 30% debt ratio, and the 60% debt ratio. Now let me explain to you the nuances involved in these calculations here. Now see, you have 3 columns where I am showing you the probability of 25%, 50%, and 25%. Now, if you remember, we talked about the EBIT in each of these cases. We have picked up this figure from the business risk. Now, you remember when we talked about a 25% probability, then the first 25% probability, the sales revenue will be 4 lakh. There was no EBIT. So here there is no EBIT. The second case, 50% chance that the EBIT will be 100. That is 1 lakh. And the third case, that the EBIT will be in 25%. That it will be when the sales revenue was 8 lakh, it would come to 200. That is 2 lakh. So I have picked up these values from the first table. Now you don't have any interest, so interest will be in the first case 0, 100, and 200. Interest is nil, so you have earnings before interest and taxes are the same, and okay. So the taxes, they have charged the taxes at the rate of 40%. So your EPS is divided by the number of shares. Now the number of shares we have picked up from the just previous table. This table we have picked up the shares, okay, equity shares, and we have used them here. So my EPS is nothing but the earning, the taxes have been deducted here, 40% tax. So once, and this is my net profit. So the first case, no profit. Second case, 60. Third case, 1,20,000. So these divided by the respective shares. If it was 0% debt, then the number of shares were 25,000. So 60,000 by 25,000, that is 2 rupee 40 paise, and 1,20,000 divided by 25,000, that works out to 4,80,000 paise. Now these are my EPS. Likewise, I have also done for the debt ratio of 30%. Again, no profit, no EBIT, 100 rupee 100 and 200 EBIT, less interest. Now you are charging interest here because 30% is your, if you remember from this table, if it is 30, if your debt was 30, my interest works out to 15. So that is 15,000. So which this value I bring it here and put it here. Interest is now 15,000. 15,000. Now see, in the first case, I don't have any profit, but I have interest. So I'll have to pay interest. From whatever source I have to arrange for finance and pay my interest. So my EBIT is a negative here. It's a loss here. And here are the figures for the respective probabilities. Now divided by, I have picked up the share and for 30% debt, my shares were 17,500. Now I divide that by 17,500, these figures by 17,500. So I get the EPS. Now here is the EPS is a negative of 51 paise. Here it is 2 rupee 91 paise, and here it is 6 rupee 34 paise. Similarly, I have done for the 60% rate. Okay. Now the point I want to make here is, let us not get lost in the calculations. This is just a calculation I wanted to show how to go about this, discussing the impact of EBIT on the EPS. Now you see, EBIT, let us pick up this particular 50% case. Now here my EBIT was 100, my EPS was 2 rupee 40 paise. Whereas if I increase the debt, the same 100 rupee EBIT gives rise to a 2 rupee 91 paise EPS. Further, if I increase the debt proportion, my EPS increases. Now whereas if I don't have debt, my EPS is not increasing that much. See, here there was no EPS, here it is 0.51, here it is 2.97. The rate of increase is the constant. Whereas in case of, now see the last case, that when it was 200, and now the similar kind of increase. Now see, 4 rupee 80 paise. Now this 634, and now the point I am trying to make is, now see, if your the no debt, then there is a there is a probability that no debt, so your EPS could be 0, could be 2 rupee 40 paise, could be 4 rupee 80 paise. Now the same thing, it could be this or this, and last case it could be this, could be this. This is negative, by the way, this is negative, this is minus 2.97. So, and this could be 3.03 or 9.03 if you have 200 rupee. So if your EBIT increases by 100%, see here, if your EBIT is increasing by 100%, now the EPS is giving, registering a big jump here. Okay, so about 200% jump here. That is the thing that I wanted to show you. Now let us talk about the EBIT EPS analysis of your capital structure. Now what we have done is, here we picked up the capital structure, the seven financing plans I have put in the left hand corner, and I have picked up the expected EPS by the expected EPS. Where from I picked up from this table, 3.03 and 2.91, I have picked up these expected EPS. How can you do that? You can do that by suppose you have 25% probability that EPS will be 0. Let us say 50% probability that EPS will be, I'm just giving you hypothetical figures, 3, and there's a 25% probability that EPS will be 4. So what you do is multiply this, multiply this, multiply this, and the sum, the total sum, it gives me the expected EPS, my expected EPS. So I have done that and put it here, the values I have put it here. So these are my expected EPS values. Now the issue is because I have now 3 values of EPS depending on the probabilities, I can also find the standard deviation. So each case the standard deviation has been found out and written here. So in order to be able to compare the risk, we have done a coefficient of variation calculation. This is wrong. This is not the plus 2 divided by 1. That is standard deviation divided by the expected EPS. So the coefficient of variation, the last column is taken out, but the first case is 1.70 divided by 2.40. So you get a value of 0.71. Likewise, the column 2 has been divided with the column 1 and we have got this coefficient of variation. Now, how do we interpret this coefficient of variation? This is how we interpret the coefficient of variation. The coefficient of variation is calculated by dividing the standard deviation of an asset by its mean or the expected value. This is what we just did. The higher the coefficient of variation, the riskier is the asset. So, see, the highest coefficient of variation was in case of 60% of your capital structure. So that is the riskiest proposition. Now, as the firm's leverage increases, leverage means the use of the debenture capital or the use of fixed charges of finance is known as the financial leverage. Now, the firm's leverage increases, its coefficient of variation of EPS also increases, signifying that the higher level of risk is associated with the higher level of financial leverage. Now, see, as we go on from 0 to 60, as we go on increasing the financial leverage, the coefficient of variation also gradually increases. Gradually and consistently it is increasing. So which means that employment of debt gives rise to the variability and which in turn gives rise to the financial risk. Next, what I am showing you here is suppose there are 7 plans. It's difficult to plot all the 7 plans. Now, suppose hypothetically I am plotting here 2 plans, plan 1 and plan 2. Now, you see, if you actually find out different levels of EBIT, like we talked about 0, 100 and 200. Now, if you talk about different levels of EBIT and calculate the various EPSs in each of these things, you can easily plot it on a graph. Now, the same thing, it's not an actual thing. We have taken a hypothetical one. Now, see, if you at various levels of EBIT, you plot the EBIT on the x-axis and you plot the EPS that you are calculating for each plan, you plot that correspondingly on the y-axis, which is the EPS axis. Now, you generate for each plan, you will generate a line. Pick up plan 1, for example, the 0% plan, 0% debt, and change the level of EBIT. So you get different kinds of EPS. Next, you pick up another plan, 30% debt plan, change the various levels of EBIT, and you go on generating the various EPS, and then you plot it on this graph. So for all the 7 financial plans, you can generate 1 line. Now, I have not plotted each one of them because that will make the graph clumsy and it will be difficult for you to explain. So, what I have done is picked up 2 plans and then I'm trying to explain what is happening here. Now, see, both these plans are crossing at a point. Now, the plan 1 and plan 2 are crossing at this particular point. Now, what is that corresponding? If I draw a perpendicular onto the y-axis, what is that particular? So this corresponds to 10 EPS. This is the EPS, so 10 EPS. And this corresponds to an EBIT of 20. Okay. Now, this point is known as the indifference point. That means at this particular point, both the plans will give you similar kind of EPS. The first plan is 0% debt plan. The second plan is 30% debt plan. But at the this particular crossover point, the the EPS will be same for both these plans. So this particular level of EBIT, that is this 20,000, or here it is in lakhs, this 20 lakh EBIT is known as the indifference level of EBIT. So the EBIT is 20 lakh for a farm. It goes for a 0% debt, it will have the same EPS, or it goes for a 30% debt, it will have the same EPS. The meaning is that. Now, there is a very interesting point here. Now look at this particular sector of the graph and look at this particular sector of this graph. Now see, below a level of EBIT which is 20 lakh, if the farm is operating at a EBIT which is below, suppose now currently the farm's EBIT is around 17 lakh or 15 lakh, which is below 20 lakh. So which means if the farm's expected EBIT is below 20 lakh, then this particular segment is doing better. This particular segment of the line, this particular segment of the line is doing better, and that means this particular segment of the line corresponds to higher EPS, and that corresponds to plan 2. So whatever is your plan 2, probably your plan 2 is 0% debt. Now your plan 2 will be better if you should stick to plan 2 if your expected EBIT is below 20 lakh. Whereas if your expected EBIT is above 20 lakh, this segment of the line is doing better. This segment of the line is doing better. And that segment of the line corresponds to plan 1. Why? Because this segment of line gives you a higher EPS as compared to this particular. I draw a perpendicular here, I draw a perpendicular here. So this segment of line is giving me a higher EPS. Now the point is, plan 1 is better if you talk about higher than 20 lakh EBIT, and plan 2 is better if you are talking about a below 20 lakh EBIT. So whatever is your forecast of EBIT, accordingly you can choose the financial plan suitable to you. Now we talk about the ROI ROE analysis. Now a very small example. Now you have two farms X and Y, and both of them have similar kind of funding, that is 200 lakhs. Now, but for the farm X is is getting the entire 200 lakh through equity, whereas farm Y is getting it through 50% through equity and 50% through debt. And for both the farms, the tax rate is 50%, whereas the debenture is 10-12%. Obviously, there is no debenture percentage for X; it is only for Y. Now see, what I have done here is I have given you the X and Y in different panels. The top panel is the capital structure of X, and the bottom panel is the capital structure of Y. Now here I am showing you the ROI, the EBIT, the interest, and the profit before tax. The EBIT minus interest is profit before tax, and from profit before tax you deduct the taxes. So you get the profit after tax, and then you get the divide the profit after tax divided by the equity or net worth will give you the return on equity. Now these things have been given here. You just have a cursory look through this thing. Now the ROI are same for both these farms, which the starting ROI is 5, 10, 15, 20, 25. Similar is for the Y. But the resulting and farm X, remember farm X has no debt. So no interest. So even if everything else, the tax rates are same, the ROIs are same, but the resulting return on equity, look at the return on equity of X, that is 2.5, 5, 7.5, 10, 12.5 for farm X. Whereas the similar, the return on equity of farm Y are quite different. Now see, first year when it was 2.5 for X, it is nil for Y. But subsequent year it is 5%, 10%, 15%, and 20.5%, which is very, very high. So this is the relationship between now ROI and ROE. Now see, the relationship is shown here. Now see the relationship ROE, net profit by equity. This is not ROA, this is actually ROI. ROI is net profit by total investment. Now how does ROE and ROI, how do they relate to each other? The ROE is the 1 minus tax. This is how they are related. 1 minus tax into ROI into plus ROI minus I debt by equity, which is the leverage. This part is my leverage part. This is my leverage part. Now the ROE is now tax rate is constant for both these firms, so this is constant. Now the ROE and ROE, the relationship is basically affected by the spread between the ROI and the interest rate. So there is the rate, the return on investment and the interest rate, the spread between these two and the leverage. Now this is what is affecting my ROE. Now if the spread is higher, ROE will go up, and or the leverage is higher, the ROE will go up. So the spread between the interest rate and the ROI and the leverage are the things to look for if you are doing this ROE analysis. Now, having discussed this part of the financial leverage, I told you in the beginning that regarding this cost and risk part, we'll be talking about several theories that have been developed to discuss the capital structure. Now, see, the firm should always, some of these things that people, they believe that there is an optimum capital structure, and every firm should have an optimum capital structure to maintain financial stability. Now, what is an optimum capital structure according to them? The optimum capital structure is the structure where the firm value is maximum. And in order to achieve this optimal debt equity mix, several theories have been developed. But let me tell you that these theories are classified. There are two schools of thought. One is a relevant school of thought, and another one is an irrelevant school of thought. The relevant school of thought believes that capital structure has an impact on the value of the firm. That is, the leverage has an impact on the value of the firm. And the irrelevant school of thought believes that the leverage is irrelevant for the value of the firm, so it has no impact on the value of the firm. I have given you four approaches, four theories basically here. The NI theory, the NOI, the net income theory, the net operating income theory, the Miller and Modigliani theory, and the traditional theory. Out of these, two theories belong to the relevant school of thought and two theories belong to the irrelevant school of thought. Now, the first and the last, the net income approach and the traditional approach, they believe that the leverage is relevant for the value of the firm, whereas the net operating income and the Miller Modigliani, they believe that the leverage is irrelevant as far as the firm value is concerned. Let us quickly go through what these theories are. Now, net income theory says that the cost of debt and the cost of equity are they're independent of the capital structure. Okay, so they remain constant regardless of how much debt the firm uses. So as a result, the overall cost of capital of the firm declines. So to put their perspective in a graph, so they say that, now see what I have shown you here is on the x-axis we have plotted the degree of leverage, on the y-axis we have plotted the cost of capital. Now, according to the relevant school of thought, they believe that irrespective of how much leverage I am employing, that means whatever is the debt I am employing in my capital structure, the cost of debt does not change or the cost of equity does not change. This is a far-fetched conclusion, may not hold good in real life, does not hold good in real life, but these theorists believe that KD and KE, cost of debt and cost of equity, remains constant, and by virtue of being the cheaper source of finance, the KD will drag the overall cost of capital to a level which is minimal as we employ more and more of the debenture. So obviously here the line, this line between this particular line shows that as we go on increasing the leverage, the overall cost of capital will reduce, and because the overall cost of capital reduces, the value of the firm goes up. That is what the approach of the NI theory is. Now, to prove their theory, they have given us a formula, the formula for the what, that the weighted average cost of capital or overall cost of capital is KE minus KD into D by V. Now, the whole issue is there is a spread between the KD minus KE. More and more the use of debt, the spread will be more, and because the leverage will be, this is constant, this is constant, this is constant. So all of them are constant in our. The only change here is the leverage. As we go on increasing more and more of leverage, the impact on overall cost of capital will be falling, because this part of the equation is constant. KE is constant, this part is constant. So higher the leverage, greater will the value of this side. So the lower will be the value of the KE, and that lower will be the value of the KO. So, and this is the NI approach. Now the net operating income approach says that the value of the farm and the weighted average cost of capital are independent of the firm's capital structure in absence of taxes. An individual holding all debt and equity, you will receive the same cash flow regardless of the capital structure, and therefore the value of the company is same. Because as I said, this is an irrelevant approach. And net operating income believes that the farm value will remain constant. So as for them, the value of the farm and the weighted average cost of capital are independent of capital structure. Why? Because they say that, see, the cost of equity and this is the relationship they have established between the cost of equity and the overall cost of capital. Now the point is here, overall cost of capital is constant as per them. So the value of the company doesn't change, because they say that as you increase more and more debt, the overall cost of equity also goes up. So in a sense, the cheaper source of finance gets offset by the increase in the cost of equity. So the impact of leverage is not felt on the overall cost of capital. So the farm value of the farm remains intact as per the net operating income approach. Then there is, you have the Miller and Modigliani approach. This is seminal work in the financial management. Now, the Miller and Modigliani approach works only under these assumptions. The assumptions are that the capital market is perfect. You have the farms are all belong to similar kind of risk, and the risk faced by risk classes. The risk of the farm, the business risk, remains constant for the particular farm. There are no taxes, and the companies all pay out the entire amount that they are earning as profit. There is full payout. The entire amount is distributed as dividend. Under these assumptions, the the Miller Modigliani, they have hypothesized that for the farms that are in same risk class, the total market value is independent of the debt equity mix. And it is how it is given. It is given by capitalizing the net operating income by the capitalization rate, which is shown here. Here, net operating income divided by the cost of debt will give you the value of the farm. Now, according to them, Miller and Modigliani, if there are two farms, suppose the two farms are alike in all respect, like they are in similar kind of business, they have similar kind of risk, they have some similar kind of, cost structure for these two farms, but the only difference between the two farms is the one farm is on all equity, the other farm has some amount of debt plus equity. So that means the financing of the farms are different, rest all things are similar for these two farms. Now the approach says that if that is the scenario, then both the farms are bound to have similar kind of values. The values of the two farms cannot be different because they are financing their operations through different sources. Because to support their logic, they have given the principle of arbitrage. Now, what is arbitrage? Arbitrage basically essentially means switching. So they say that the company which is employing leverage has corporate leverage, and the company which is not employing leverage has no leverage. But what will happen is, if a company which is using cheaper source of finance, it has a higher value, then what will happen is the investors will switch from this particular company to the company which has no leverage, and they will borrow money on their own and create their personal leverage. So they will replace the corporate leverage with the personal leverage, or some people also refer to it as a homemade leverage. So they will create a leverage on their own account, and then they will invest in the company which is the no leverage company. And by doing so, the company, the value of the investor will be maximized if we invest in the no leverage farm. There is a elaborate mathematical calculation involved here. For the lack of time, we will not be discussing that. Now the point is, so you can switch from corporate leverage to personal leverage or homemade leverage, and you can create value for yourself. So everybody will switch from the levered farm to the unlevered farm. So what will happen is there will be a selling pressure on the levered farm, and there will be a buying pressure on the unlevered farm. So you end up, the unlevered farm will, the price will go up, and the levered farm the price will come down, and until it will continue like that until both the farms come into equilibrium. So basically, even if there is a difference between the price of the value of the two farms, the arbitrage process will ensure that the values are brought to equilibrium. So that is the reason why they hypothesize that the values cannot be different. Okay. Now the second proposition is that the financial leverage causes two opposing effects. Now because of which the values don't change. Now what happens? It increases the shareholders' return, but it also increases the financial risk. Okay. So when you are taking debenture, you are not only increasing your return, you are also at the same time increasing your risk. Now the shareholders will increase the required rate of return, that is the cost of equity on their investment, to compensate for the risk that they have to take. Now because of this behavior, the cost of equity for a levered farm will be higher than the opportunity cost of the capital. So the levered farm's cost of equity is more than the opportunity cost of capital, because because now the kind of investment you had made initially, the risk has gone up. So you will switch to, what is opportunity cost? If you invest in another avenue, what should be your level of return? So that is the opportunity cost. So here, actual cost of capital will be, cost of equity will be more than the opportunity cost of capital. So that is how they will compensate. So in essence, the value of the farm will also remain constant as per the proposition. Now this is again, we'll come back the NOI and the where irrelevant approach. That means they say that the leverage is irrelevant for the value of the farm, whereas come back to the last approach, which is the traditional approach. It says that, well, leverage does have some impact on the value of the farm. Now what does this approach argue? It argues that if you have moderate degree of debt, then it can lower your overall cost of capital and thereby increase the farm value. Now to show this, I have a graph. Let us go to the graph, then we'll talk about this. Now see, here you have a graph which says that this particular graph is clearly could be divided into three phases. First phase, okay, this is the first phase, this is the second phase, this is the third phase. Now see, according to traditional approach, the cost of debt remains constant irrespective of the debt you are taking. But what happens is, so because the cost of debt is constant, and more or less initially, as you increase your leverage, so you're taking more and more of debt. On this side, I'm showing you the total leverage, the amount of debt I'm taking. Now, cost of equity is higher than my cost of debt. Now, as I go on from starting with no debt to as I go on employing a little bit of debt, cost of equity is high, cost of debt is low. So this particular stage, what will happen is my overall cost of capital will be reduced due to the impact of the cost of debt, the cheaper debt. So it will be the overall cost of capital will fall initially. So in the first stage, you see this segment of the line, it is reducing, because my overall cost of capital is reducing, and my farm value, which is my net operating income or my EBIT divided by the KO, or you can say, no, let us do net profit by KO. That's okay also. Now, so because we're not talking about taxes, I'm talking about EBIT. Now, EBIT remaining constant, if your overall cost of capital falls, the value will go up. Now, in the first stage, the value will go up because your overall cost of capital is declining. Again, in the second stage, what will happen is, now with the increasing debt, the equity shareholders, they will perceive financial risk. So they will revise their asking rate. The cost of equity will go up. Now, the cheaper source of finance, the increased cheaper source of finance will be offset by the increase in the cost of equity. So the overall cost of capital will not register much of fall. See, in the first stage there was a big fall, but the later part it will not fall. So it will remain more or less constant. Because of that, the farm value will also remain constant, because now my KO in the second stage, my KO will remain constant, so my V will remain constant. And the third phase, the cheaper source of finance is no more able to offset the highly increasing rate of equity. Now, equity investors will perceive high risk. Now, this increase, which was gradual in the second stage, it will be steep in the third stage. They are perceiving a huge amount of risk taken by the enterprise, so they will revise their cost of equity. And because of the increased cost of equity, the overall cost of capital will also drastically increase, and because of that, now your cost of capital will drastically increase. So this will result in the fall in the valuation of the firm. So this is the approach of the traditionalist, who believe that yes, the leverage does have some kind of an impact on the capital structure, or I mean the farm value. So which theory is correct, which theory is not correct, that is open for discussion. But obviously, and the approach has some but if you remove the assumptions, and if you subject the approach to tax, then obviously that even the approach becomes a relevant approach, where the employment of debt to some extent does have an impact on the valuation of the firm. So this is the discussion about on your capital structure, and how the decision making is to be made in capital structure. So and how the businesses can finance risk, how they contribute to the capital structure decision. So we end our discussion today. Thank you.